When people feel the worst about the economy, that's often when the market performs its best. Strange, right? But this is one of the fascinating dynamics we see when we dig into consumer sentiment, a gauge of how people feel about the economy. In March, the preliminary consumer sentiment index slumped 7 points to a lower than expected reading of 57.9. Now, this was the third consecutive decline, bringing sentiment to its lowest level since 2022. The sharp deterioration is historically consistent with a slowdown in economic growth, as consumers typically pull back on spending. Consumers broadly are expecting a deterioration in the months ahead in their personal finances, labor markets, inflation, business conditions, and the stock market. Also, the gloom was widespread across political affiliations. Let's now zoom out and look at the data historically. When consumer sentiment is at its lowest, the stock market tends to rally, often strongly, over the next 12 months. In fact, the average return for the stock market following a sentiment trough is just over 24%, compared to just 3.5% after sentiment peaks. Now, to be clear, this is not a prediction of sentiment being at a trough or that markets will perform strongly over the next 12 months. Our observation here is just that sentiment bottoms tend to be a good time to own stocks. So what gives? Why the disconnect? Well, part of it is emotional. People feel uncertainty, fear, even frustration when headlines are packed with layoffs, trade tensions, and technological disruption. Whether it's tariffs, AI displacement, or government spending cuts, these are all real concerns and they weigh heavily on sentiment. But the markets? Markets are forward-looking. They're not reacting to today's emotions, they're pricing in tomorrow's outcomes. So now you may be wondering, are we at a market bottom or sentiment bottom yet? Well, that we don't know, and making predictions about how people will feel down the road is like predicting where the stock market will be next month or next quarter. Our view is to have a plan, a diversified investment approach, and the ability to take action. You see, markets will go through periods of decline in any given year. As of this recording, the U.S. stock market is about 7% below the highs set back in February. Looking back over the past 45 years, the stock market has experienced intra-year declines of 14% on average. However, still finished positive 75% of those years. Now, this 75% win rate, which is consistent with the last 100 years of data as well, is how investors are rewarded over the long term, accepting uncertainty in the short term in exchange for growth over the long term. Here are the takeaways. Consumer sentiment can be a contrarian indicator. When confidence hits the floor, markets may already be laying groundwork for a rebound. The stock market goes through periods of market decline for a variety of reasons, with each decline triggered by a different set of events. Despite this, the market still has positive outcome 75% of the time. Lastly, we recommend having a plan in place, owning a mix of diversified investments, and being ready to take action. If today's discussion got you thinking about your own financial plan, or maybe about someone you care about who could benefit from a steady hand during uncertain times, we'd love to hear from you. At Vector, we help individuals and families navigate complex markets with clear, actionable strategies tailored to their goals. You can reach out to us directly through our website or give us a call to schedule a conversation.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or